Good morning. So thanks Amit for a wonderful presentation, and thanks PMS for inviting us to make this presentation. Before getting into the slides, I just want to give a brief about Sundaram Alternates. Sundaram Mutual Fund, many of you might be knowing, has been there in the asset management business for a long period of time. Sundaram Alternates also have been there for the last 12 years now. And Sundaram Mutual Fund, as you all know, has been known for mid and small cap. We have the first fund to launch the mid cap fund. We were the first fund, AMC to launch the small cap fund and micro cap fund. So orientation has always been on the mid and small cap space. So Sundaram Alternates was started as a focus area as the mutual fund moved to large cap, mid cap as a diversification. So if you look at our journey, we have been there for 12 years. We have created returns of closer to 18 to 19% CAGR return across 3 of our strategies, almost 5 to 6% alpha since inception. And your money which has been invested since inception has almost gone up to 8 times from the time it has been invested from some of our investors who started with us in the journey. So this is the brief. Today we manage close to 5,500 crore of money. Roughly 4,000 crore out of it is in the equities, and another 1,500 crore is in debt. And as a team on the equity side, we have 5 research analysts with the fund management team, and we have a very large operation team anyway. So this is the brief about Sundaram Alternates. So I'll get into the presentation. Before I start, I just want to set certain things into context. So when investors ask us, like, what is the most sustainable way, consistent way, and you have to remember we have a 12 years of journey, right? And in 12 years, we have seen, particularly in mid and small cap, at least 3 cycles. If you look at 13, 14, it was an upcycle and then followed by a very sharp correction or a moderation for almost 3 years. And then 16, 17, again an upcycle and then a very sharp decrease, almost like 25% fall in mid and small cap in that period. And then again 21, 22, an upcycle, and we have seen through all these cycles, and what drives these market cycles, what leads people, what changes in this market cycles is something which we have gone through. So when people ask us how to be consistent in such huge market cycles, particularly in mid and small cap, I think you need to do 2 things right if you want to be a little more consistent and sustaining. First is, we need to identify certain mega trends that are happening in the economy at a particular point of time. And we will get into what are these mega trends. And second is, select the right stock within those mega trends and invest in them. See, the mega trend is very common to everyone, right? Everybody knows about this. But there are very specific trends within these mega sectors which are doing really well. If you can identify them, then invest into the right stocks, and that's where the key differentiation comes. The remaining 90% is common to all of us. The last 10% about selecting the right stock, that's where the filtration happens, and that's where the real play of the fund management comes. So if 2 things can be done more sustainably and the entire research team can be focused on this, then I think the alpha creation becomes much more easier and sustaining over a longer period of time. So in this journey of identifying what are those mega trends and where India is poised to. So Amit made this interesting point that India will double its $1 trillion, $3 trillion in the next, say, 7-8 year time period, which is what every one of us are looking at. But the contributors to this $3.5 trillion in terms of growth is going to be substantially different from the first $3.5 trillion contributors. So as a fund manager, my focus is which are these trends which are going to contribute more to this $3.5 trillion and identify the profitable companies within it and invest in it. When we get into this, when we observe some of our neighbors and what they have done, there are some interesting aspects. So some learnings from what happened in China, what happened in US and all, but most importantly, how India is kind of moving in this journey. That's a very important part. But some learnings are there when we look at the other countries also. So let me take 5 minutes to just highlight certain points on what was the journey of China and what mega trends created. We named this the presentation as ginormous because when we looked at China, when they transition in this period, certain sectors have become 10 times their size in 10-year time period. 10 times. And if you have the right stock within those sectors, then I think most part of your work is done. You don't really need to keep fighting and looking at the stock and keep churning for you to create alpha. If a sector can grow 10 times and you have the right stock in it with the right cash flows, then I think most part of your work is done, right? So that's the reason why we have mentioned is some of these sectors, when I highlight to you in specific slide, you will see how big they have become in 10-year time. So what happened in China? So all this starts somewhere like $2,000 per capita. I think N number of fund managers would have come and talked to you about $2,000 per capita income. What happens after that? So China did it in 2006, US did it in 1960s, and Germany and Japan did it in somewhere closer to 70s. But post that, definitely one thing has happened. The curve looks steeper and some sort of a J curve starts hitting. So something is happening at $2,000. But not that every country which has touched this $2,000 has become a big, say, superpower or something. So every country gets this chance, but not that everybody converts it also. These are classic 4 or 5 countries who have made this. One country which is missing here is South Korea, which has also done really well from a period like this. So what they did? Let's take only China because we are running short of time, so I'll just cut short on certain slides. So let's take only China and look at what happened and what are those mega trends that happened. So what happens when a $2,000 per capita income starts growing at 10%? So India will be growing at 10% nominal GDP. So what happens in that period? What happened in China in that period? Obviously, we will not be mimicking China because China's growth is phenomenal from 2006. But there are certain inputs from it. So we are taking the inputs, and we are realigning to India's story. So what happened in China? It's an interesting slide. Lot of inputs you will get. The domestic savings starts increasing. So average household, if it starts earning more income, what happens? 2 things you do, right? One is your saving is disproportionately higher than your income growth. Your savings will get into either bank savings, which is the last thing that you guys keep it, or it gets into property, it gets into equity. So domestic savings went up 8 times in China in this period of 2005 to 2021. And look at the banking assets. It has gone up by 22 times. Why this happens? The savings gets into banks, and then every household starts leveraging. When I highlight how India is positioned from a household debt to GDP. So after a particular level of income, we go for household, we go for a housing loan, we go for a vehicle loan, we go for a premium cars, we go for housing loans and all this. So as a country with a 140 crore population and say 40 crore of the population lives and starts looking at housing loan as an opportunity, you cannot imagine the size of housing loan market can be. And that happened in China. And banking assets went up almost 22 times. So this is a trend that happened in China. Very similar thing we are observing happening in India as well. How you play it, we will discuss about it. Second is China chose manufacturing, and China gave this dream to the world that we will be the lowest cost manufacturer for you. India probably may not choose this. India will play some sort of a balance between manufacturing and services, in our opinion. But there will be sectors which lifts the economy and starts creating jobs, right? So that phase happened in China between 2000 in this period, and then this entire growth led to a massive domestic consumption. That's the third phase. When the domestic consumption happens, again there are sectors which have grown 10 times, and we will show that in one of the slides. And then the fourth segment comes, the spending in R&D and moving to high tech. So China is currently challenging US on the electric vehicle, or even Europeans, right? The kind of amount of capacity that China is putting in terms of electric vehicle battery manufacturing is almost 10 times the demand that China will have. So what is the plan of China? China wants to just go and dump electric vehicles across the world. China is no more interested about dumping steel, metal and all those stuff. It is done. These sectors China wants to leave it and wants somebody else to take it over. Probably India can do it for the next cycle, but China wants to do more of electric vehicles, locomotives, high tech. So that is the transition, that's the fourth phase. Mind you, I see that India in certain specific sectors is able to touch upon those four. We call it as India is the cheapest technology service company, probably not the cheapest manufacturer, but India is the cheapest technology service country in the world. And IT is a proof of it, and we have certain sectors where India has proven this. So this is how China has happened. So is there any learning for us? And can we look at something for India? So where is India? So first point is India is in $2,200 per capita income, so we are there. But what we can do from here? What are the enablers? There are certain enablers. I think largest working population. So obviously any country wants to manufacture anything and ready to pay the price for our labor. India has enough labor, which probably Vietnam cannot offer after a point of time. Probably other Asian countries which have competed with us cannot offer after a point of time. So India has labor now. Now it's up to us how to make use of it. And globally, countries are after COVID looking at India seriously. So that's a point. Very, very, very good base is set. Next 7-8 years there is an opportunity. Now whether India will make use of it, we will wait and see. We have a very good adoption of technology in India, which definitely in China, between the period that I talked about, 2005 to 2010, when they grew from $2,000 per capita income, was definitely not so tech savvy like what India was. So we are adopting technology as good as a developed country, or even better than the developed countries. Some of my friends who come from USA, there is no such UPI. And the way UPI has gone up in India, that everywhere everyone is adopting it. These are the things which is by nature it is forced, right? China and India will be very different from how technology adopted compared to other countries, because we have a large population, an aspiring population, and a large young population which is growing, who are ready to adopt technology much faster. So that is another enabler for us. And the third is, because of sheer size, there are certain sectors where India has become number 2 or number 3. Again, China is a very far distant guy in each of these sectors. You take auto, China is very large. China almost manufactures 1.4 crore cars. India is manufacturing around 3 million cars. So there's a long way. But from at 3 million, India will be almost third largest car maker. If you take entire Europe together, then probably one more like now. But as it is, we are almost third. In steel, again we are second largest manufacturer, but China is a very distant first. China will be something like 1,000 million ton, and India will be 120 million ton. But I think nobody between us and everyone else in the world is lower. So scale is becoming, what is the important point? We are becoming scalable at this point. And with scale, you will get advantage of cost. Scale. So this is the phase that India is right now. And luckily we have some policy reforms oriented towards Make in India. I would say most important of the 4 points that we mentioned here, the last one is the major enabler. So these points are always there, right? We want to do policy reform, we wanted to do digitization, and demographic advantage is always there with India. But this 4th point is adding to it. Post-COVID, or I would say it's not just post-COVID, you go 10 years back, China started becoming a problem for the global supply chain. I think it all started during Beijing Olympics when they shut down certain chemical plants without any sort of warning, and then that led to a massive increase in chemical prices at a point of time. So from then, time and again, due to various reasons, and off late due to COVID, the supply disruption has been heavy, and China is 30% of the global trade is supported by China. So then you can imagine the kind of fear that a global manufacturer will have when China kind of switches on. So that's what happened during COVID period. So I think globally everybody wants to move away from China. They are not shifting out of China. They are saying, okay, if I have to add another capacity, can I look at any other country? And India is definitely there on the radar. And that is creating an opportunity for us. I think that is a major enabler, and that's what I said. Next 7 to 8 years, India will get this opportunity, and how we make use of it is what India is going to do. But there are enablers to this. So, keeping this, what I spoke so far, let's look at what is that 4 themes. Now, let's go back to the first point that I mentioned. When I said that if we can identify the mega trends, invest into those mega trends, and identify the right companies in it, most of our work is done. One more major enabler when it comes to stock market, we call this entire process of stock selection as value migration. What do you mean by value migration? Sectors which are very small today, or probably even large, but can become multifold. The banking is not a small sector, but it can become multifold, as you saw what happened in China. And there are sectors like consumer discretionary in India is very small at this point, but it can become 10 times of its size. Each of them can become 10 times of its size. When this happens, what happens? It replaces some stocks which are there in the Nifty. Today, if you look at Nifty, if you want to play FMCG, if you want to play consumption, you can play only FMCG. But the real growth is happening elsewhere. And when these companies in the retail, in the other discretionary space become bigger, they will replace FMCG. In this process, if you participate, you will definitely be creating alpha, right? That is what is called as value migration. This has happened in US, where none of the current US large companies in the indices was not there, say, 20 years back. So this transition has happened. So this is what's called value migration. The entire play for Sundaram Alternates is to identify the value migration space. In that way, we think these four teams are playing well. So let me start with financial inclusiveness. I think you are with me when I said that financial assets increases, average household income increases. They do two things, right? One is they borrow more for the housing loans, vehicle loans, and I'm talking about middle income pricing. And second thing they do is they invest a lot. They invest in non-savings. They go into alternates. So they're looking at the kind of money flowing into alternates. It's a proof that we have reached that stage in the urban centers much more faster than the old country as it is. So these two things happen. So how do you play this now? So we have played the first part and we have made a lot of money. Sundaram Finance has been a classic story of how an NBFC can create wealth through the investors by lending into vehicle finance space. And we have gone into housing loan. So we see three trends here, and I don't know whether the numbers are visible. I just read out. There's no point. So this slide here, it talks about what is the household debt to GDP percentage. And India's number is here. It is not visible, but it's a very small at this point compared to developed markets and other countries. Per capita growth to drive.
No, the legends, right?
Household. So three components in the debt: household, the non-financial corporation, and government.
Oh.
If you look at the household debt, hardly anything in India, 15%. So there's a long way to go in terms of growth. If you look at the other countries, the household debt to GDP, it's almost like 100% in many of the emerging countries also. And in some of the developed markets, it is more than 100%. So that's what I said. When the income level increases, it's not that everybody saves alone. It's actually you start getting and borrowing more for certain assets. So three segments benefits a lot in this. One is household debt, the housing loans. Second is vehicle loans, and third is actually the small business loans. We talked about a lot of ATM, right? So small business loans, because a lot of them depend on unorganized lenders, so they come into picture. So we have retail banks, large retail banks like ICICI and Axis in our portfolio, but that is not all about. We will play this household debt to GDP increase, but that is not all about. We will go to the next segment, which is a more interesting segment, which is about lending to people who are otherwise not getting the lending from an organized player, which is where a large amount of growth will happen, as well as if you can get the right profitable companies in this space. That's how Sundaram Finance came into picture, right? Nobody was ready to lend for tractors, and Sundaram Finance came in there and then played a large role. Today that space is now occupied by banks. Now Sundaram Finance goes to the next level. So this is how it happens. So financial intermediation, NBFC is a great play to participate in financial space, and that is what we are planning to do. Half of our, say if we have 30% allocation to banks, we will have 15% to large banks and 15% to some of these emerging growth opportunities. This mortgage debt to GDP, I just took mortgage as an example because that's the data that we have. It's an interesting data, and it will be very good to, what is this? See, a lot of things we talked about per capita income and income level growth and all this stuff, right? When it comes to lending, as much as opportunity to lend is there, it's very important to collect it back. So lending is the easiest way, but collecting it back is the most tough thing. So in Sundaram, what we understand is, if you are participating in certain regions where the income level is better, then this risk is much, much lower. There are two Indias here, you can see. This is mortgage to GDP ratio of select states. You can see these states here. This is Karnataka, Tamil Nadu, Kerala, Telangana, Maharashtra. These states are high on per capita income compared to the other states. So lending to these states, one thing I have understood is companies which are started here, which have moved from western part of the country to south. You can see during COVID as well as during D1 was the least impacted companies in the financial space compared to many other companies. And I don't need to mention what is happening in eastern part of the world in terms of lending and kind of write-off that they have to do in their financials. But if you look at most of the financial companies in this part of the world have come back post-COVID, although they were lending to the most under, in terms of income, represent a very low set of categories. So something about this states, right? The overall income level is so good that the risk of lending to even the people with no proof of income is still much lower. So that we use as one of our way to select the stocks also. But this is something which you have to keep in mind. Obviously, I said there are three opportunities: affordable housing, vehicle finance, and then in the second leg of opportunities, when I said affordable housing, vehicle finance, particularly used vehicle finance is becoming a very interesting opportunity. And then third is the small business loan. We have stocks like Home First Finance in this, 5-star Finance in this, and we have made a lot of money in Bajaj Finance playing this entire story. And although not exactly this, but that was a space that was left by banks and NBFC made use of it. So when you select an NBFC, just ask this question: what is it a bank cannot do or lend in this business that only this NBFC can lend? Obviously, the companies that we are selecting, banks will take a lot of time to reach there. Nobody can beat the banks when it comes to lending because they have an advantage of cost of funding. So if you're selecting NBFC, be sure that you are buying a company which is not going to see the competition from banks. That is why in the mid caps, when we look at PSU banks, power financing companies, we ask this question: we don't really feel the moat. What is it the other banks or private banks cannot do, which a PSU bank can do? Or what is it a PSU bank cannot do, which these power companies can do, which are large part of the mid cap story? So these are some questions that you need to ask when you select the companies. The second, I said, is a large jump in the consumer discretionary. I'll come to it, then step into the fiscal. So what happens is the number of households which earn more than 10 lakh increases multifold. So almost our estimation is based on BCG and Morgan Stanley's report, there are some 10 crore households which will earn more than 10 lakh in the next 10 years. So 10 crore households who will be earning more than 10 lakh means they will be spending a lot more on health, education, dining out, traveling, all this stuff. Many people will pay this, but within that, so why it is very important and why we say you can go short on FMCG and you can go and buy these companies. This we have been doing for the last 8 years now. And why we feel that? Because the growth opportunity in front of you and much more stable. If you are playing FMCG, you are playing rural consumption mainly. Because the growth for FMCG companies comes from rural consumption. And rural consumption is a play of monsoon. So you have to pay every year if you are holding an FMCG company that monsoon is good. But if you are playing urban consumption, what it has to do with is only the salary growth. And if you look at the NSE 500 salary growth, it is 12.5% for the last 10 years. So when people talk about inflation, slowdown elsewhere in the world, or slowdown in India because of monsoon, I don't think it really matters to people sitting in the urban centers. So our approach to investing in consumption is just focus on urban consumption and invest into the right companies within those urban consumption. There are many companies, but you have to choose based on certain filters: competition, ROC, cash flow, all this. So we will talk to it later. But our focus is purely urban consumption. I'll show you some interesting data. And I said that there are certain consumption baskets which have grown 10 times in China. And when the transition from $2,000 per capita income to where they are right now, the numbers are mind-blowing. If you look at the number of KFC stores in China right now, it is 8,000 stores. In India, we have two stocks, Devyani and Sapphire, who run KFC in India. Together, they have only 600 stores. Even Jubilant has reached 1,500 stores. These two are less penetrated in my opinion, and India is a good chicken eating population as well. 8,000 stores, okay, forget about what China is right now. In 2006, when China was $2,000 per capita income, there were 1,800 stores. And ideas like this, and it's a very profitable business. If you take KFC, they make good profits at the store level in KFC. It was a loss making 5 years back, they've turned it around. They've made it smaller stores and they've gone everywhere in the city rather than focusing on only malls. And it's a profitable business, generating cash, just has to reinvest into number of the stores. This is exactly the call that we took on Trent and Titan 8 years back. That when we bought Trent was just running 100 stores in India. When we mapped into the urban centers, we thought that at least they can penetrate into another 100 cities and have at least one store in each of the cities. and they can double the number of stores. And actually they have gone much beyond that. They have now added almost 250, they are almost 300 stores right now. And importantly, they also added one more brand called Zudio that has become another 300 stores. So that's what helps you, right? When you invest in the right companies who are generating cash, you are buying it for a particular story, and the story gets extended because they invest into another profitable opportunity. So this is the stock selection process. But look at the opportunity. Where we got this idea of trend? When we prepared this data and we looked at Zara. Zara was just so much store in China in 2006, and today it is 600 stores. Zara is not going to be so big in India quickly because Zara is slightly higher on the price. But you can always play it through another company which is very close to Zara, in my opinion, is Westside. And they were learning it from Zara because Zara and Westside have a joint venture in India. And they were showing a lot of signs of doing it right in India. So a lot of our ideas flew when we put this comparison between various consumer discretionary baskets and looked at. So the idea like a trend came from there, idea from a Titan came from my wife. The amount of money she keeps on spending on jewelry. But I told her, just buy only what you want and let me invest in Titan, because a jewelry will give you only 7% CAGR return because the price of jewelry has gone up by 7% CAGR in the last, say, 5-6 years. While a Titan will give you market share increase. So it can add another 5% to 6% to you by store stock because of the revenue growth. And another 5 to 7% it can add because it gets into profitable segments like carat lane, studded jewelry. So these together will create you at least a 10 to 12% additional return than investing just purely on jewelry. Although it's the same play. As the jewelry price increases, it charges on the grammage. So you will also benefit from the price increase. So that is these are long-term trends, and these don't get changed because of what is happening elsewhere in the world. Once you get them, invest in the right company. So we have opportunity of investing into Tangamail and Kalyan. But go back and see how Tangamail and Kalyan, in terms of profitability during falling gold prices or stagnant gold prices, very small margins, very little left. And if you are running a gold business, you have to hedge it. The hedging cost itself is so high for you. So these are certain small things you have to pay attention when you identify the profitable business out of these large trends that we are seeing. The third very interesting and very close to our heart is manufacturing. Manufacturing, we played in the last 4 years through specialty chemicals, purely the China business story. And if there is one sector which we can thumb the table and say which benefited from China business story, it is chemicals, particularly specialty chemicals, where clearly we have seen Indian companies. Say for example, we have a stock called Navin Fluorine. 5 years back when we invested in the stock, the company used to make 100 crore EBITDA and used to invest 100 crore. Today the company is investing 700 crore of money every year in capex. In just 5 years, a company, and also generating closer to 450 to 500 crore of cash. This 700 crore, almost next 4 or 5 years, I don't see any change. And each of these will have at least ability to double the money in 4-year time period minimum, in my opinion. And like this, there are other 4 or 5 stocks which we feel in the specialty chemical. So we played specialty chemical as the China placement story. Also, we played Dixon Technology, which we have exited now because valuation has gone crazy. But we were believers 5 years back. Post PLI, it has become a consensus buy. But 5 years back, people thought India's Make in India story was not there. Today, everybody, it's a consensus buy that everything which is put the tag of EMS gets a 40 times, 50 times valuation. Be careful. It's not a business where you can pay 50 times. It's a very low margin business. People are praying for growth, and I think they have fully paid it. Now, margin of safety is very, very low because just imagine the reason why we got out of Dixon when it was at a 50 times multiple is Dixon, when we bought, was having or probably addressing somewhere closer to 3,000 to 4,000 crore of revenue in terms of products. And by the time when we got our people projected it till FY26, and the absolute volume that they were have to handle was something like 50,000 crore. Imagine a company managing a 3,000 crore business and managing a 50,000 crore business by taking just a small margin for assembling those units. It becomes really difficult. Margin of safety is very, very low as you progress. But markets, when they are crazy, and that is what is called as bull market, they don't have time to pay attention to these risks, and they are ready to pay any price. And this we have seen in 2017. History is repeating again in 2022 and 23. This is what investors should be cautious about. So we exit when we see that too much of hype, and it can happen in small and mid cap. because of the illiquidity of stocks in that space, we have to be a little more careful on just staying invested in those things. Some opportunities have been bigger and bigger, like what I said on trend. We bought for Westside, Zodiac came, it became bigger. We bought Titan for India, domestic story, now they are going international and they are investing in Caribbean, story is becoming bigger and bigger. So these kind of companies keep on identifying new opportunities, but that's not the case with every other company. And also we have to keep in mind profitability and competition. Once you become bigger, so Dixon was the only name in EMS, today there are some 6-7 companies, right? And all of them are almost closer to 10,000 crore market cap before they reach any size. But we are interested in the electronic space, but we will be careful about it. But this data is very interesting. Increase in the manufacturing as a percentage of total capex. It was mostly driven by infra till recently, but now almost 50% of India's manufacturing story is in capex is in from manufacturing. Railway and defense are good areas to be, but not from a stocks perspective because stock prices have gone up just by the mention of defense orders. And one thing I have to warn you, I have tracked the defense sector myself as an analyst. The order book converting revenue takes 5 years, 10 years. Now people look at an order flow, next day morning stock is up 10%. It takes 10 years and they are booking everything in the first day itself. But yeah, we have seen certain specific sectors. I don't know whether it is visible from the back, it's not visible to me. But there are sectors like ethanol, because of the green energy drive, data centers, sectors like even small steel capacity, value-added capacity. After a long period, we are seeing a very broad-based sort of capex of ticket size of around 500 crore, which is not the case in the previous capex cycle. Previous capex cycle was all about power and steel, where mega capex was done. And every day we used to get up to see a 1,000 megawatt order or capacity getting announced. That was a different story. It was 2004, 2008. Today it is more broad based and in many sectors. So much more sustainable, I would say. So you can play manufacturing, but you need to be very careful on whom you pick. Today capital goods valuation are also very stiff. So we have come out of most of the holdings that we had last year because the valuations have gone up 40, 50 times. They can grow 15-20%. But currently the stock prices are demanding almost 30% growth from these stocks, which looks difficult. But I think you need to be choosy. We have some 4-5 ideas in this and we are playing that. So this is what we wanted to say, and this is the story that I said, and we started as almost 12 years back being there, and these are the 3 strategies that we have: CSOP, Self and Wider in the PMS, and these are the 3 Cat 3 funds we have. Close-ended, 2 of them, Atlas is an open-ended one. Broadly 10 to 15 stocks to 20 stocks maximum in most of our strategies. Mix of both large caps and mid caps, but more thrust is on the mid and small cap space, but very, very choosy. So at most I will be owning not more than 15 mid and small cap ideas out of the 1,000 stock universe. So a lot of filtration goes before we select a stock and based on these. This is the Cat 2 thing, and this is right now 1,500 crore. So the point that is the thing is this: we are not saying we will be making you 30% CAGR return, 25% CAGR return. Our target is very different. We target somewhere closer to 15 to 20% depending on which portfolio you are choosing. But we want to increase the certainty quotient. There's a point in this. We want to increase the certainty by targeting a 15-20%, while Nifty will be 10-12% sort of. How you increase the certainty? As I said, get the trends right, and second, select the right stocks. If we can pick a mid and small cap, which is in no way lesser in terms of its balance sheet and promoter, in terms of as good as a blue chip company, then as you when people ask me, we don't want to get into mid and small caps. A lot of investors say this. We want to just be in blue chip. So the point that I say to them is, you invest in blue chip, but blue chips not necessarily are there only in large caps. They are there even in mid caps and small caps. But they are growing faster than the large cap blue chips. Invest into them. By investing into them, you are not taking additional risk, but you are likely to get 4 to 5% additional alpha. That is what our the entire journey has been, and that's what we plan to do in the next decade as well. So thanks for your time. Really appreciate it.
In case anyone has any questions, please feel to ask.
Talking about China
China, right? You mentioned that all the things that we can learn from China and so on. But now that the China itself, the stocks are down, why we not invest in China itself?
China is actually part of many alternates funds globally in China also. They are looking at, but China is now for alternates. It's like a start and stop, right? They can take this risk. They have taken this 3 times post-COVID itself. But I think what China is in a transition phase. So China probably for next 3-4 years probably may not show a big growth to you, but China, to me, it cannot be written off. They are transitioning to a different, as I said, they are no more concerned about the chemicals and basic commodities. They are now moving into high tech. And I can clearly see activity driven from the top on those sectors. So we are talking about China-Taiwan issue, and most of the issue, if you look at, it is all about the amount of money that has been spent in Taiwan to create capabilities to manufacture chips. And China wants to overtake it in no time. So that tension, those things will keep going on. But I feel that China is now challenging US on its doorstep. But US as it is, given the way they have built the country by bringing talents across the world, will always keep finding new things to keep growing. But yes, today the gap that was there between China and the US in terms of technology, say some 30 years back, has almost come very, very close. So China's focus is, can I make use of it? Because that space is now being completely vacated by Europe, Japan and Korea. So China can rightfully take that place and then say they can provide a lot of this high-end technology at the right price. Where India can play is the next step. We will provide technology at a cheaper price, but not a cutting-edge technology, but obviously like specialty chemical I said, which requires a value add. It is not pure manufacturing. If you are trying to do basic chemicals, India will not do well. But if you are doing a value add, India can do well. That's what a lot of things are proving, and I would say something like the Chandrayaan 3 is the proof of it, that we can do the rocket launch or a moon landing, but at a much lower price. You can understand this and relate it to many sectors, that we can do an IT service. A Bangladesh or a Vietnam or a Thailand will never be able to do IT technology service, right? So it's a space where you can be very active about. But if you want to do a textile business in India, then you have to be really careful, because our labor cost is already higher than many of our competing nations. So that is, I think India is in between, China is slightly above in that technology curve. So I think these are two trends that I see.
So relatively, right? Relatively, for the same amount of funds invested in either countries, where would you expect more growth?
So China, see, equity, although everyone says it's a long term, but unless the story really plays out, you will probably wait and play, right? Obviously, given the valuation at which China is, if there's a small turnaround also, you will make a lot of money, and it happened for a short period until again the China story again went down. So people will again keep going, but is there a structural story? I think that will take another 2-3 years before they kind of move to the next leg of growth in a big way. But I think there is enough challenges for them to face from other countries before they can get into this structure.
Your AUMs are less for all these alternate funds. Is there a reason?
Which alternate funds?
No, the funds you have put in this brochure and the ones you have shown.
So I will tell you, this is the PMS one. In this we have totally 3,000 crore and put together all the three. And in these 3 alternate funds, together we have another 1,000 crore. There's 4,000 crore on AUM in equities. This is the CAT2 fund. This is debt fund, real estate, and we recently launched the corporate credit fund. This corporate credit fund has got almost 1,000 crore of the commitment. So the number showing there is the first close. So it's already got, we have to update that slide. They have already got 1,000 crore. So together the CAT2 is right now, from a commitment point of view, almost closer to 1,500 crore. Yeah.
What's your CAGR been across the 3 PMS portfolios that you just showed earlier?
CAGR?
What's your CAGR been across
these 3, right?
PMS, yeah.
These 3 since inception closer to 18-19% CAGR.
And what about the cash flow? How many years?
This is just started, 1 year old.
Oh,
Just close to
all
that.
3.
In the premier fund, it is 14% CAGR return. This is almost 4 years now. In the Econ fund, it is more than, this is a 3-year, more than 24% CAGR return. This Atlas fund is been only for 1 year now, somewhere closer to the 12%, the 13%.
very interesting.